You're not?
All right, welcome back to Squawk Box here on CNBC. First in business worldwide. I'm Joe Kernan, along with Steve Leisman, Gary Kaminsky, and Andrew Ross Sorkin is live at the L.A. Bureau. There you can see Citigroup is reporting numbers that I guess are not surprising in light of J.P. Morgan's results. As always, you can imagine what we're going to have to delve through to get a clean number on Citigroup. Also on Wells Fargo, two at once we're going to do. While we analyze these numbers, which just hit, Chris Whalen is here.
Yeah, let's bring Chris Whalen for more analysis here, and we are looking at the numbers, Chris.
And they're hitting. So
yeah. We've got revenues of Citi of $17.2 billion versus the $18.5 billion. So it looks like a revenue miss going to the bottom line. So no surprise there?
No, everyone's coming in light on revenue. We've talked about this on this show for a couple of years. There's been a real tough visibility on any revenue for most of the large banks. The small and medium-sized banks have stabilized. Some of them are growing. But you have to get down to a U.S. bank to see a bank that was actually growing revenue organically. But that was because they're taking share from other people. The pie is not getting bigger.
Guys, is this a big miss here? Am I missing something? 38 versus 49, 38 cents here. Joe, you feel good about the 38?
That's a big...
Go ahead.
It's a big miss,
Steve,
but it doesn't surprise me.
Yeah.
Go ahead, Andrew.
Andrew.
No, Steve, I was going to say that's a big miss both on the earnings side and on the revenue side. But I think the earnings side is what's
down to the earning. We have to see how it flowed down to the earnings. The revenue miss. You know, Chris, you mentioned about the revenues.
Right.
Are the revenues down, falling, or are they have they gotten to a level where the bank managements can now try to figure out what the normalized earnings are? Or do you see revenues continuing to decline here the rest of 2012? Because that's really the key issue here.
Well, with the large caps, investment banking trading came to the rescue for the last couple of years, even as the banking, especially the mortgage banking and sales side of that business was flat to down. The banks made up for this with higher spreads on less revenue. And now what we're seeing is that the investment banking side, the trading side is not there in a lot of
what's
firms.
your prediction on? Always thought it was the cream of the crop. Will they beat revenue or miss revenue?
I think miss down small.
They beat.
Miss small.
Yeah. No, they did beat.
Yeah. Oh, really?
Yeah.
Well, look, in a big enterprise, depending on your attitude as treasurer, you can make results come in wherever you want. I've been very critical. Again. Look, I've been very critical of Wells and their disclosure.
Then why wouldn't anyone missing beat?
If that's a good point, though. It depends. You see, these people don't just manage this business for one quarter. They're looking 4, 6, 8 quarters out. Yeah. So there is a little bit of management here.
Well, Wells doesn't have the investment banking capital markets business that probably
which is good today, right? I want to make a couple points here, Gary, real quick.
Wells Fargo 73 versus 73.
Right, that's a beat.
That is, but I will point out that the so-called whisper number on Wells was 75.
Where did it come from? Was it more cost savings? Because they have been absolutely obsessive on the cost
Exactly, because 72, not necessarily the estimate. I know that's
here's the thing I've been following with the banks, Chris, and I'm interested in your thoughts on this, obviously. What's happened to credit quality? And I see here Wells Fargo says, quote, absent significant deterioration in the economy, we continue to expect further reserve releases in 2012. They reserve for stuff.
That's right.
Things get a little better than they expected. Right. They release reserves. I'm also seeing Citigroup say here that, I lost it, but I think they said reserving was down something like 40%.
Oh, definitely. Well, that's
so talk about that and the macro implications of that. Is credit getting better in the economy, and is that something that makes you reasonably upbeat about the banks in the future?
It's certainly better in terms of credit costs that the banks have had. Right. So provisioning is down. That's where they're getting lift in terms of earnings. If you don't have growth on the revenue side, then you're getting it on the cost side.
Releasing reserves.
Now, I will say that I look at these reserve releases with kind of a mixed feeling because if we do see a flat economy going forward in 2012, 2013, then you could see charge-offs go back. And these banks
and it's also not a business model, right? My business is not releasing reserves. It's making loans and making profit from that.
Look at Wells versus U.S. Bank. U.S. Bank is not going to be releasing reserves back into income because they don't have to.
Okay, it looks like book value, year over year. Right. Book value per share up 8% to $60.78. This is on Citi. Tangible book value per share up 12% to $49.81.
They've rallied, but they're trading at half the book value multiple of Wells.
Well, again, that's the real, for investors out there, for viewers out there, they hear every day, people come on the air, these banks are all trading below book value.
Right.
Below book value.
Some.
Below book value.
Wells is actually fairly valued, I think.
So let me just ask you, is the book value relevant to be looking at?
Right now it is, yes, very much. And forward earnings. You have to look. All I can say to you is this: is that the big guys still have a lot of issues, and they have no visibility on revenue or earnings going into 2012. From U.S. Bank on down, the industry is getting better, and this is where I think we'll see credit growth. Going to the whole issue about the economy.
Tell us where U.S. Bank is. It's about what number?
Number 5.
Number 5. So 5 down. So those are the banks that you like and are interested in.
So.
But 5 and higher, is it because of Dodd-Frank capital rules?
Oh, very
all
much.
of the stuff. Those are big issues with the banks.
I've interviewed so many people who've lost their employment on the street because of Dodd-Frank, the Volcker rule. It's disgusting what's going on.
We're going to see Goldman Sachs and Morgan Stanley later this week.
But hold on. Those guys at the banks, they're moving to other places.
Well, they
right? I mean, those prop trading desks are picking up essentially.
You and I both know that the prop desk did not cause the crisis.
Oh, yes.
The syndicate desk.
Yeah.
And does the Volcker
the one
rule,
that maintains as part of their business
does the
model.
Volcker rule permanently take a piece out of the earnings for these?
Yes, very much. You know, it's 5, 6, 7% at J.P. Morgan because that business is gone.
Right.
They had a whole group that was running treasury for the bank that was also doing private equity, other types of investments. Going forward, they're just going to run treasury. Any tactical trading around treasury is just going to be buy and hold.
Quick follow-up on this, because when you look at the Volcker rule, the speculative trading, the prop trading is still permitted in treasury securities and agencies.
And when I say treasury, it's the bank's investment.
No, I know. I'm segmenting a little bit because my concern is, doesn't this in a way constitute a form of financial repression?
Oh, I think so. Look, we should have less government involvement in these banks, then we wouldn't have to have the Volcker rule. We wouldn't have to have a lot of Dodd-Frank. Resolution authority, I support that. If we could have just gone up to about page 160 in Dodd-Frank, like the Marx Brothers, and just torn the rest off and thrown it away.
Instead of
2,000, we didn't need.
Chris, let me just read some numbers to you. Okay, fixed income, this is at Citigroup now. Fixed income revenues declined 25% from the prior year period.
Right.
Equity market revenues, excluding CVA, DVA, declined 71%.
Mm-hmm.
Investment banking revenues declined 45%.
Right.
Is that in line with, we've seen J.P. Morgan, we've now seen these numbers. Is this the sort of overall thinking in terms of what these businesses, again, are going to look like? Yes. Because I think as it relates to Goldman Sachs and Morgan Stanley later this week, those are the only relevant points.
No, so that's right. I think that's absolutely right.
This is going to be the levels, the recurring revenue levels that the banks are going to be able to figure out how to make money in terms of this is the run rate.
Well, if you think of banking side, trading side, the trading side is definitely slowing down at all these firms. And you can see it because all of my operations contacts in the business are lightening up unemployment expenses wherever they can. They're running around desperately in many cases. And it's getting to wear on people because we've been doing this for 4 and 5 years in these banks, looking for cost savings, At some point, we've got to start growing.
I just want to make the point that, I mean, I don't support the Volcker rule, but the idea of the Volcker rule, that you should not be able to trade and then have access to the government guarantee, that makes some sense, right?
Let's get rid of the government guarantee.
Exactly. Shouldn't have the government.
Well, hold on. The government guarantee is the deposit guarantee. Anything worked well during the crisis, we did not have deposit runs on banks.
No, but the industry funded it. The industry funded every aspect of that except for Citi, the explicit bailouts. The Citi funded all of the deposit insurance load. And Sheila Bair did not have to go to Treasury for money.
So you think that it makes sense that they should be able to do prop trading, and if that prop trading it did not, but if it were to go bad, then they would have access to the guarantee through that.
No, look, if a depository stumbles and fails because of stupidity on the prop desk, they ought to be resolved.
Is, Steve?
No bailouts.
Steve, stay here one second. Andrew, you still out there? Andrew?
I'm still out here. I'm right here.